Hey guys, welcome back. Today, the liquidity map, where stop losses really pile up and why price keeps reaching for exactly those levels. Here is the whole idea on one real chart. This is Apple in January. Look below the market, first two lows weeks apart, stopping at almost the same price. Under a floor that obvious sits a pile of resting orders. Every dip buyer's stop loss parked under the level. Traders call it a pool. Now look above a shelf of highs at the same price with the pile of buy stops sitting over it. Price is parked between two pools of fuel, and watch what it does. First it reaches down and drains the pool below, then it turns, walks back across the whole range, reaches up, and drains the pool above too, and keeps going another $18. That was not random. Price moved from pool to pool like a magnet. Learn to mark the pools and you stop guessing where price wants to go. Here is the routine. Here is the routine, 4 steps, and the fourth one keeps you off the wrong side of every obvious level. Clean diagram first. Step 1, mark the external pools. Find the levels everyone can see, matching highs, matching lows, the last big swing in each direction. Above every obvious high sits a stack of buy stops. Shorts covering, breakout buyers waiting. Below every obvious low sits a stack of sell stops. Those stacks are pools of resting orders, and the biggest players in the market can see them just like you can. Step 2, find the internal fuel stop. Between the pools inside the range, there is usually one zone where the last strong move launched from. That zone is where price refuels on the way to the next pool, and that is your entry area. Because risk is smallest in the middle of the map, never at the edges. Step 3, read the draw. Price does not wander. It moves from the inside of the range out to the nearest pool it has not visited yet, and matching highs are not a wall, they are a magnet. The more times a level holds, the more stops pile up behind it, and the harder price gets pulled there. Step 4, trade toward the pool, never into it. Entry at the refuel zone. Stop beyond the zone with a buffer. Never parked at the obvious level where the whole crowd keeps theirs. Target in front of the pool so you are paid before the crowd fights over the fill. And if a trade only works by pushing straight through a nearby pool, skip it. That is trading into the magnet. Mark the pools, find the fuel stop, read the draw, and get paid in front of the crowd. Now let's run it on 3 real charts and 1 trap with our 3 traders. Meet the 3 traders taking every one of these setups, each starting with $10,000. First, this is Mike. He marks the pools above and below, buys at the refuel zone in the middle, and takes his profit in front of the crowd. Next, this is Jake. He treats every obvious level as a wall. He shorts double tops, leans on double bottoms, and parks his stop exactly where everyone else does. And finally, this is Tom. He waits until the pool is already drained, then chases what is left. Same charts. The only difference is how each of them reads the map. Pool number 1, the magnet above. This is Micron this spring, and the level that matters prints in the 3rd week of March. A rally dies just under 470, and the market rolls over hard. Look what happens next. A brutal slide, a whole month of selling, a bottom, and a violent recovery. And through that entire round trip, the March high is never touched. Then in mid-April, the rally comes back to the exact same price, and stalls there again, almost to the dollar, matching highs. Mike marks the shelf, and the pool of buy stops sitting on top of it. Every short from that level keeps a stop up there. Every breakout buyer has an order resting there. That is fuel. Jake sees the same 2 highs and calls it a wall. He shorts the second touch, full size, with his stop just over the shelf, exactly where the crowd keeps theirs. Mike does the opposite homework. The leg that came back up moved so fast it left a refuel zone behind it. A band of prices the rally skipped on the way through. His buy order rests at the top of that band. His stop sits beyond the zone with a buffer, and his target sits in front of the shelf, paid before the fight even starts. The pullback comes 2 days later and hands him his fill, and then the engine turns over, one giant green candle drives straight into the shelf, and the pool drains. Every stop above those matching highs becomes a market buy order. Jake is blown out in the run by his own stop. Mike is already paid in front of the pool, almost 2 to 1. And here is the part most traders never connect. Once the pool above is drained, there is nothing left to hold price down. Micron adds 50% in the next 2 weeks. Tom finally believes it and pays the top of the next morning for his entry, sweats one red day, and steps off with $120. The magnet paid the trader who used the map, not the ones who argued with it. After Micron, the map already shows in the money. Mike bought fuel in the middle and got paid in front of the shelf, while Jake stood in front of the magnet and became part of the fuel. 1 level, and the pool decided both trades. Pool number 2, and this one proves that pools do not expire. This is Goldman Sachs from February into May. In February, the stock stalls twice just under 950, matching highs, a shelf the whole street can see. Mike marks the pool of buy stops sitting above it and waits. Then the market falls apart. A month-long slide all the way down near 780. $170 of pain, and then a slow grind back. And through that entire round trip, the shelf above is never touched. The stops up there did not go anywhere. Pools age, but they do not rot. By late April, the recovery is back at the shelf and stalls again. Now look underneath. The pullback that follows holds twice at the same floor, to the dollar. Matching lows. The map now shows two pools. A small fresh one below and a 3-month-old monster above. Structure has been climbing for 6 weeks, so the draw points up at the bigger and older pile. Mike rests a buy just above the lower floor. His stop goes beyond the floor with a buffer, past the crowd, not with it, and his target sits in front of the wall. The fill comes on the next dip, and 4 sessions later the target prints. Paid, in front of the crowd, nearly 2-to-1. That same morning, Jake opens a short at the wall. Third touch, he says, it held twice, it will hold again. 2 sessions later, the pool drains, the shelf breaks, every stop above it becomes a market buy order, and the squeeze rips through the level without a single pause. Jake covers into the squeeze for his second loss. Tom buys the breakout the morning after, holds through a $40 shakeout, and sells the moment he is green again. And Goldman? Once the wall was drained, it ran $50 more within a week. The oldest pool on the chart paid the most, to the one trader who treated it as a target instead of a ceiling. 2 pools in, Mike is compounding by doing the least exciting thing in trading, getting out early, in front of the crowd every single time. Jake has now donated twice to the same magnet. Pool number 3, because the map works in both directions. This is Amazon, and this window ends this week. Late April prints a hard flush down to a low. 3 weeks later, another flush stops within $1 of the same price, matching lows. Below a floor that clean sits a pool of sell stops. Every dip buyer's exit order, parked under the obvious level. Now the top side. The bounces in early May die at almost the same high, and the rallies after that keep dying lower. Lower highs? Pressing down on a floor everyone is leaning on. The structure points down, so the draw points down, at the pool under the floor. Mike will not buy a floor the market keeps testing. Instead, he rests a short up at the supply shelf where the last 2 rallies died. His stop goes beyond that shelf with a buffer, and his target sits in front of the pool below, paid before the flush. Jake reads the same chart and sees support. He buys the second test of the floor. No stop because floors always hold. The bounce into the shelf fills Mike's short. 3 sessions later, the floor gives way, price slices through the matching lows, the pool drains, and every sell stop under that floor becomes a market sell order. Mike is paid in front of the pool, nearly 2-to-1. Tom shorts the breakdown a day late, covers into the next flush because he is scared it snaps back and keeps a crumb. And Jake, he is still holding. He finally dumps it a week into the slide, $15 under his entry. The floor he leaned on was never a wall, it was a battery, and the market came down to collect it. 3 pools, 3 payouts. Mike never predicted a single move. He just traded at the resting orders and let the magnet do the pulling. Jake has leaned on 2 walls and a floor, and the market has collected all 3. Now the trap, and it is the prettiest setup in this entire video. This is Snowflake from March into this week. Late March, a rally dies at 177. Then a disaster. The stock loses a third of its value in 3 weeks. And then the long road back, a bottom in April, and a recovery that grinds higher for 5 straight weeks. In mid-May, the recovery arrives back at the March high and stops 7 cents away from it. 7 cents 2 months apart. Every textbook on earth calls that a double top, and Jake is already short, full size on the rejection candle because resistance is resistance. Mike sees something completely different because he reads the map. 1 matching highs that obvious mean a huge pool of buy stops right above. 2 months of shorts defending that shelf. 2 months of breakout orders gathering on top of it. 2 look at the lows. They have been climbing for 5 straight weeks, pressing price into the shelf like a spring. Demand is walking price into a wall of fuel. That is not a ceiling forming. That is a launch pad loading. His rule is absolute: never trade into a pool. If the map says anything here, it says up, so he refuses the short. And so does Tom, who cannot decide what he is looking at. A week after the second touch, price walks up and takes the shelf. The pool drains, the stops fire, and the candle closes right back at the highs. Jake is now $6 underwater on a full-size short he holds. It always comes back, he says. 2 sessions later, earnings. The stock opens 35% higher. There is no stop loss to save him. He is short oversized into a drained pool on earnings week. He finally covers at 270, nearly $100 above his entry, for the worst loss of his year. The prettiest double top on this chart was never a ceiling. It was 2 months of fuel, and 1 glance at the rising lows told you exactly which way it was wired to fire. Here is the whole season on one screen. Every level met by all three traders. Mike took 3 trades and banked all 3 fuel in the middle, paid in front of the crowd, almost $3,000 of edge from one idea, trade toward the resting orders, never into them. And the trade that mattered most was the one he refused, the prettiest double top of the year, which was actually a loaded spring. Tom made money. But the map works in advance, not in hindsight, and Tom always arrived after the pool was drained. He paid retail for every entry, so a season of being roughly right bought him a few $100s. And Jake, 4 trades, 4 losses, nearly half the account gone. Notice he was never wrong about the levels. He found every important level in this video, he just stood on the wrong side of them with his stop where everyone could see it. The levels were real, they were just never walls. Same charts, same levels, the map decides everything. So here is your whole liquidity playbook on one screen. 1. Mark the external pools matching highs and matching lows, the levels everyone can see. Buy stops live above the highs, sell stops live below the lows. 2. Find the internal fuel stop, the zone inside the range where the last real move launched, because that is where risk is smallest. 3. Read the draw price moves from the inside of the range out to the nearest untapped pool. Obvious levels are magnets, not walls. The more a level holds, the more fuel piles up behind it. 4. Trade toward the pool, never into it. Entry at the refuel zone, stop beyond it with a buffer. Never at the obvious level. And target in front of the pool so you are paid before the crowd. A setup that needs to smash through a nearby pool to work is not a setup, it is a donation. Trade in the direction of the resting orders. Get paid in front of them. That is the entire edge. That is the liquidity map, not lines that hold but pools that pull. Mark the external pools, find the internal fuel stop, read the draw, and always get paid in front of the crowd. Next up in this series, order flow, delta, and the footprint. How to see the real buying and selling aggression inside each candle, the part the chart hides. Subscribe so you don't miss it, and drop a comment with the ticker you want broken down next. See you in the next one.